You guys hear that? Chirp, 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 chirp. Welcome to Tech Talk. I'm here at MarketStream.live. My name is Joseph Cusick from the Cusick Group, securities offered by MoneyBlock. Well, as I had said, it's strategy now, and this morning, watch the Russell 2000. That's the lagging index. And if you take a look at the rut right now, it has pulled back. It's now down 14, down almost 1.1% at 1353. It's definitely making a statement right here, and it's challenging these lows that we haven't seen since last week. And so with that being said, what I wanted to do is spend some time in Tech Talk taking a look at some large cap tech stocks, maybe some sector ETFs, just to give you some context after this move. And the context that I'm going to give you is both from a technical perspective. We're going to look at the charts. I'll give you the option analysis, in other words, the estimated move, and then just basically ranking implied volatility, because right now, vol is still ridiculously low. As a matter of fact, if you take a look at the VIX right now, it's trading at 1220, but it's popped basically about 8% in the last hour. So it's been pretty impressive. First stock I want to look at is Apple. Now, Apple has been in the headlines quite a bit, and so I wanted to take a look at Apple because this is one of the darlings of tech. Apple right now is holding up quite well with the pullback right now, not only in the general market, but also in the NASDAQ. The NASDAQ came off, now down 0.25%. But the Apple's been holding up at 144.25. Basically, what I wanted to do is look at it. It's over its 20 and 50 days, so right now you can definitely see that the bulls are still in control there. But again, we've had some mixed headlines. There's some concerns potentially that they're going to push the release of the new iPhone. Now, of course, that's typically in September, but they're talking October and November. And just looking at the general landscape, one of the sectors that is a catalyst or an offensive sector is the consumer discretionary. If we see that the consumer is starting to cool off into the spring and maybe into the summer session, that could put some stress on Apple, which has made an impressive run to the upside. Right now, Apple has an IV rank of 37.3. Put that into context, that's in the upper third, almost half in that middle range as far as when you get into a zone where you're thinking there's going to be a heightened sense of big violent moves. Once you get over 50 on that ranking scale, that means that there is a large possibility of violent moves either up or down. And with the market, the NASDAQ, by the way, had hit today all-time highs ever. Higher than the bubble in 2000, all-time highs. So you're seeing Apple also trading up in the stratosphere as well. And so, again, wanted to give some context there. Over the next 8 days, Apple is pricing in basically a 2-point range in the $144 stock. So basically, you're looking at a little bit better than 1% range being priced into the stock. Let's see if that changes if the markets start to get a little bit more volatile, especially as we close out this first week in April. Now, taking a look at the S&Ps, we're going to take a look at a sector ETF, the spiders. In full disclosure, my clients have removed the position that they had on. I removed that. I had a resting order to remove the position, and with the spider pullback, that position was removed, so I'm no longer exposure in full disclosure in the S&Ps at this juncture. The S&Ps have pulled back pretty dramatically, and as a matter of fact are now trading below that 50-day moving average. You can see it here, trading at 235.09, down 39 cents. Coming off of those highs, it got as high as today at 237.39. So you're seeing a pretty dramatic pullback here of almost 2.5 points. So pretty impressive move right now to the downside, and the bulls have lost control in the short term. Post the Fed minutes, basically there seems to be a sentiment that Fed's going to shrink the balance sheet, but they may not be as aggressive on rates. Who knows? We've had a lot of turmoil at the Fed right now, or at least some volatility, if you want to call it that, with one of the Fed presidents pushing up his retirement. He resigned because he basically as he should have. Basically went out and acknowledged that in 2012 he gave non-public information to a reporter. Bottom line is that we're getting volatility now represented in here. We're back in the battle zone for the S&Ps. Right now, for the next 2 days, the S&Ps are pricing in about $1.50, $1.60 range. So on the $200 underlying, you're basically looking at about 0.5% or 0.6% of potential movement going into this end of the week, so the next 2 trading sessions. You still have, though, the implied volatility rank very low. Even though we've spiked 12 on the VIX, the implied volatility rank on the spiders is at 11. Again, not a heightened sense of huge violent moves, but if vol starts to pick up, in other words, get above that 13, 14, 15 level, that's going to change that IV rank. Taking a look at the emerging markets. Now, we talk about Europe, we talk about which is more mature markets, but then we talk about the Asian markets. And looking at EEM, which is the emerging markets ETF, we see that it's bounced off of its 20-day moving average. So the bulls have been in control, but it's been in a big consolidation here. We're waiting to see. Now, with this currency movement that we've seen today, where we had some dollar strength earlier, but then the dollar weakened pretty significantly, we're going to see if that puts pressure on the emerging markets. You can see right now that the emerging markets are pulling back down 9 cents now, well off of their highs. As a matter of fact, we saw the high of the day today was at 39.90. It's trading at 39.50, so it's come off 40 cents from the high of the day today. We're going to watch this one very closely. You can always go back and take a look at the overnight action report where we look at Asia. But right now, a challenge of the 20-day moving average at 39.32. And this is an ETF that doesn't move a significant amount. It has a low implied volatility rank of 14.9, almost 15. So there's not a heightened sense of movement. And the range right now for the next 2 days is 27 cents in this $39 ETF. So you're basically looking at a little less than 1% move being priced in. Let's see if that actually shifts a little bit now that we're starting to see a little bit of volatility in the market. We've talked about the small caps. Like I said, and as I had opened this Tech Talk piece, IWM, the Russell 2000, chirp, 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 right? Boom. Look at this. You gotta love the sound effects, right? It just broke down pretty significantly. This was leading the way down. As a matter of fact, if you look at a shorter time frame, let's say the 30 minutes, you can see it after the Fed minutes came out, it just started to plummet. As a matter of fact, we came off of the highs of the day, which were at 137.41. We're now trading at 134. So you've basically seen over a $3 shift in the IWM. That's a pretty significant move. As a matter of fact, the options were only pricing in a range of around $1.41, either up or down. So we're going 2 times right now what the options we're pricing in. That's significant and needs to be looked at and understood. And more importantly, I think that is a potential red flag for the markets, and we need to basically make sure that we are respecting that. So keep your powder dry in small caps. We're going to be watching that non-farms payroll. That could be a catalyst for the bulls, or at least something that could could maybe stem some of the selling that we've started to see this afternoon. And that will be on Friday. That's going to be, there are other reports that are coming out between now and Friday, but the non-farm payroll and the employment number are going to be the numbers that are going to be market movers. Also headlines, of course. Also, taking a look at Bank of America. I wanted to take a look at the financials because one thing that I'll note is that we've seen that the bonds have really taken a swing. The 2-year has come off its lows. The 10-year and the 30-year treasuries on the price side have bounced pretty significantly going into the end of day and into Tech Talk. So bottom line is that we are seeing a bond market that we thought maybe could be getting a little bit weaker on the price side. Yields going up, that would be beneficial for banks and financials in general. We've seen that the financials have basically been in a grinding non-committal type of range. And right now, with this pullback, we have the short and midterm bulls looking like they could potentially start to sell in Bank of America. We're going to watch this. Right now, Bank of America has an implied volatility rank of 22. That's relatively low, in the lower third of a range between 0 and 100. So not a heightened sense or expectation of a big move, but it is down 1% right now. Let's see if that temperature starts to change a little bit, especially now that we have a little bit more uncertainty in the market about the Fed, about future infrastructure plays, tax reform, healthcare. You know, this Trump rally and all of those components that were built into it, the hopes and promises, as I've called it in the past, aren't coming to fruition as quickly as possible. There could be some trimming of profits here. 34 cents is the range that the options market is pricing in for the remainder of this week in Bank of America. It's already moved 24 cents. So you're seeing that the move that was baked in by the options is almost being fully priced in just with the action that we've seen today. So very interesting action in general, and we're going to watch it. Join us at the close, 4:30 Eastern Time. I will wrap all this up here at MarketStream.live.